Okay, good evening, everybody. Hi. Welcome, evening, welcome, and other things. Hello, everybody, and welcome to class number 8, the last one in the set for the tuition phase of P7. Just before we get into the advanced auditing stuff, some things I need to tell you. This is the last of the tuition classes, which means after today's class, some additional things will be appearing on your platform. There are going to be a couple more progress test questions appearing, so you can start testing yourself on the knowledge and technique in advance of revision. In addition to that, there is a summary of the audit standards, so the ICERs PowerPoint presentation, and that is going to appear as well, should be going up tomorrow. What else? Hi. What else have we got for you? Some tips for what's coming up on the exam. They'll be up tomorrow as well. I must apologise, I'm still full of cold, as you can probably tell. And what else? Yes, the must, should, could list, which analyses the last few evenings of the last few sittings, and looks at which questions are the ones you really must be doing, given the exam sitting that is coming up, which you really should do, and the ones you could do if time allows. On that subject, many of the must questions will be the ones I'll be doing on the revision course. Just a reminder, we have, will there be any mock exams? Yes, there will be mock exams. I'll come back to that in a minute. Revision is 4 classes of 2 3/4 hours each, plus, as part of revision, you get a 1-hour Q&A session right before the exams. Now the P7 exam is on a Monday, so I can't do the night before because that would be a Sunday, and we don't have any staff in the office, security or anything else. So I think I'll need to look timetable wise, but I think I'm due to do the P7 final question and answer session on the Friday night, which I think is the 28th, and then your exam is on the Monday. On the subject of Q&A sessions, we have our second mentoring session on Thursday of this week. So 5:15 as usual, half an hour. Chance for you to ask any questions you need to ask. And as always, I will come along to that session armed with something for us to do. So if no one wants to ask very many questions, we can still use it wisely. One little note, this weekend coming up, on Saturday night, Sunday morning, the UK clocks will change by 1 hour. We go backwards. So if you are currently 5 hours ahead of the UK, you'll end up being 6 hours ahead of the UK. So please bear that in mind when you are looking at class times, especially on revision. Okay. Fabulous. What are our plans for this evening? Oh, sorry, Nikita, mock exams. Everybody, mock exams. Yes, there is a revision mock exam for each paper. These are scheduled to happen during mid-November. They are marked by tutors like me, hello, and a timetable for that has been agreed, and when the revision planner goes up for P7, it will be on the revision planner. And the revision planner for P7 should be going up within the next day or two. All the dates agreed some time ago. But just so you know, yes, mock exams absolutely scheduled to happen part way through revision. Unfortunately, we'd love to have it that we do tuition, then revision, and then have a period for mock exams. We simply cannot run all the revision classes at the same time. It would be clashes galore. So some papers have revision fairly early, some have it more middle, some have it a bit later. It's just the way it has to be, I'm afraid, which means in some cases the mock exam is after revision, but on some cases it's going to be part way through revision. We can't, well, I mean, you can sit the mock exam as late as you like, but if you want it marked and returned before exam day, well, there are obviously limits as to how quickly we can turn things around if I don't have any tutors in the office because it's the last weekend before the exams. So we're a little bit limited in that respect. But as with all the mock exams, there will be mock exams, answers, and a full video debrief of the mock, typically lasting 30 to 45 minutes, with tutor showing you how to attempt each of the questions and the key learning points and technique therein. Can we sit for the mock exams if we haven't taken the revision package? I have to admit I don't know the answer to that question. I think maybe you can pay for the mock as a separate package on its own, separate from revision maybe. I'm pretty sure the mock exam though is part of the revision package, but I'm not the right person to ask. I don't do the pricing and the packages, I do the academics. So if you don't get an answer to that, Nikita, through admin, if you email me and I'll pass it on and we'll find out the answer. I honestly don't know. Yeah, and on the subject of revision, guys, this is a really practical paper. If ever there was a time you want to pay for revision, this is it. On the tuition phase, as you'll have noticed, I'm relatively limited with how many questions we can do because I've got a syllabus to get through. On revision, it's questions, 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 and that's the most important stuff. That's where I can show you the technique working over and over again on multiple questions. So please, if you haven't booked revision, you want to. Okie dokie. Excuse me. Time to get going then, I think. We won't be talking about football today after my club's disastrous 3-2 defeat to Liverpool yesterday. Ugh, not good. So let us get going. So, off we go then with our final class. What have we got left to get through tonight? Well, we've got a little bit left to look at in the reporting chapter, including, we're going to look at a past exam question that's got some audit reports in it. We did the theory of audit reports, the technical stuff last time, and tonight we'll finish off chapter 6 plus look at a question. But also tonight we're going to be looking at our final core area of the course. Non-audit assignments, which is chapter number 7. Whoops. And then finally, we are going to look at some current issues, and that's where chapter 8 comes from. So let's get straight into it, and chapter number 6. So, last time we looked at audit reports in chapter 6. We looked at the contents of the audit report and we looked at the 7 possibilities which I put up on the screen. That left us with a couple of things left to look at in the chapter. But before we go back to the class notes and look at that, we are going to go straight into a question. Not that one though, and not that one. What we're looking at here is the December 2007 paper, And I'm just scrolling down to question number 5. So, December 07, question 5, which you will find in your revision kits on pages 131 and 132. Okay, so the question starts off by saying to us, we must assume today's date, December 2010. And part A of this question says, evaluate whether the audit senior's proposed audit report is appropriate, and where you disagree, recommend the amendment necessary. There are 2 companies we need to deal with, and as always, we must note the number of marks as they tell us how many individual points, comments, thoughts we need to get into our answers. And as we can see, it's 6 marks for the first one and 4 for the second. So before we go read the stories on these 2 companies, how are we going to earn our marks? Well, if we're talking audit reports, the sort of things we can talk about are going to be, if there is a misstatement in the account, something is wrong, we should talk about what rules they're breaking, the technical side, the accounting standards. Why are they wrong? If there's a lack of evidence, we should describe what that lack of evidence is. Now, of course, those are the 2 reasons why we change the audit opinion, mistaking the accounts or lack of evidence. But for each of those, there are 2 levels of problem: pervasive, material. So we're going to have to talk about the relative importance, materiality, of each of the 2 issues as well, assuming that the 2 issues are to do with those 4 audit report opinion modifications. If it starts talking about other information, you know, the unaudited stuff in the company's annual report, well, if that's the subject matter, we need to identify, is it right or wrong? And if it's wrong, we then get into other matter paragraphs. Or I suppose it could be something in the accounts which is right but so significant, emphasis of matter. But really, we're only talking there about 2 separate things. What's the outcome? How material? So there's a couple of angles to get marks. Another way to get marks is to talk about the impact on the audit report. Any of the 4 modifications means an explanation above the audit opinion. If it's one of the 2 extra paragraphs, they go underneath the audit opinion. So just trying to get a feel for the sort of things we could say that are going to generate marks, because they're not worth 2 marks each. These 6 and 4 means some detail. Okay, let's go look at the first one then. Just expand this up a bit, get a bit more space. Right, off we go then. You are the audit manager for 3 clients at Bertie, a firm of chartered certified accountants. Financial year end for each is the 30th of September. Okay, well that sort of fits, doesn't it? If the today's date is December, so 2 and a bit months after the year end, yeah, we'd sort of expect the audit work to largely be finished. You are reviewing the audit senior's proposed audit reports for 2 clients, Alpha and Dima. Okay, here comes the first one then, Alpha. Alpha, a listed company, permanently closed several factories in May 2010. Well, here's what I'm thinking. Permanently closed sounds to me like IFRS 5. Discontinued operation. May 2010 is before the year end. So this is very much sounding like a discontinued operation. All costs of closure finalised and paid in August before the year end. So no provisions will be necessary if everything's been paid. The factories all produce the same item, which sounds like a separate division of the company is stopping. It contributed 10% of total revenue for the year. Last year a lot more, but then of course last year was a full year. This year they've closed it during the year, so that makes sense. So in terms of an answer, I'm already thinking that for my 6 marks, my starting point for my plan has got to be to say, under IFRS 5, this looks like a discontinued operation. Why? It seems to be separate. It's closed before the year end. And it's clearly material to the company's operations. And if it is a discontinued operation, which it seems to be, what are the accounting rules? They should have separately disclosed the performance of this division in both profit or loss and cash flow. That's what I'm thinking. So there's the starting point, identifying what the issue is. In this case, it seems to be an accounting issue. Back we go. The closure has been discussed accurately. Oh, how disappointing. That's starting to sound correct. And fully in the chairman's statement. Whoa! And director's report. Well, chairman's statement and director's report, that's other information, not the financial statements. So is this an other matter paragraph? Well, no, because other matter paragraph is where there's something in the other information that is wrong. It's not wrong. From what I'm reading, it's right. So back to my answer plan. I might be tempted to write in my answer the other information, i.e. the unaudited bits of the annual report, appears to be correct. So no other matter paragraph is needed. So it's not about other matter. Back we go. However, the closure is not mentioned in the notes to the financial statements, nor separately disclosed on the financial statements. So it's not in profit or loss, it's not in cash flow statement, and they've not done it anywhere in the notes either. The accounts don't mention this. And last time I checked, the accounting standards apply to the accounts. That's why they're called accounting standards. And since those disclosures are missing, we have got a breach of IFRS 5. They have failed to disclose the information in the accounts which should be disclosed there. Now I'm thinking, okay, I know what the answer to this is. They have a misstatement in the account, so there's two possible answers. If you think it's material but not pervasive, except for qualified opinion, if you think this is so pervasive that it impacts across the accounts, then we'd be talking adverse opinion. Well, their figures are all correct, their profit figure will be right, it's just they haven't analysed it out between the profit they're earning from continuing operations and the profit they've earned from the bits that they've closed. So the totals are all right, but there's a lack of detail. I would suggest that there is no way on earth you can say this is adverse. Not in a million years. I repeat, IFRS 5 is a disclosure standard. It does not tell you where to put debits and credits. It's just analysis. And on that basis, no way is it adverse. They've only made one mistake. Which is a lack of analysis of their figures. Totals, e.g. profit, are correct. And on that basis, I would be suggesting an except for qualified opinion. And whenever you change the opinion, you should say that an explanation of the missing disclosures should be in the basis paragraph above the opinion. And that, to me, is the answer. Now, good exam technique at this point says, whoa, have we got enough? Because this was a 6-mark answer. 1, 2, 3, 4, 5. Oh, well, I seem to have 6 points, so this is looking pretty good. And I've not yet commented on what the audit senior is suggesting. And there's good reason for that. I don't know what the audit senior is suggesting. There's no need to read it. Work it out for yourself first. There's always a danger here that if you go and read what the audit senior suggests too early, before your brain's worked it out, whatever the audit senior suggests is going to influence your thinking. Don't let that happen. Work it out for yourself. Because that is the answer. So what's the audit senior going to say then? Let's go take a look. The audit senior has proposed an unmodified audit opinion for Alpha as the matter has been fully addressed in the chairman's statement and director's report. Well, the audit senior is wrong. And now I can see the explanation I need. The senior is wrong because IFRS 5, like any other accounting standard, applies to the financial statements, and the chairman's statement and director's report are not part of that. So disclosing it in there is fabulous and well done to them, but it has to be within the body of the accounts because that's what the accounting standards apply to. So there we are. There is the first of the stories. In terms of audit reports, as long as you know your outcomes, it's not that difficult. But of course, you do need to know your IFRS 5 in order to understand what the accounting rules are. But also note there is a sort of subtle bit of testing here that you understand the difference between the accounts, where the accounting information goes, and the other stuff, for which there are no rules, and it's up to the directors what they say. Okay, there's the first one. Let's now look at the second one, which only has 4 marks attached. In October 2010, well, October 2010 is after the year end, so I am now thinking IAS 10, events after the reporting period. I'm also thinking that events after the reporting period can be adjusting, or non-adjusting, or non-adjusting, but if they're really significant, they get disclosed. Now, an adjusting event is anything that happens that gives you more information about the true position this company was in at the year end. It says a legal claim was filed against DEMA. If whatever they've done wrong, they did wrong before the year end, then this becomes an adjusting event. If the crime is after the year end, it's non-adjusting, but if the crime is after the year end and is huge, and has going concern implications, if they lose the case, then I'd be talking about disclosure. So that's how I'm looking at it. And if the crime is before the year end, the adjustment, of course, well, this would be a provision under IAS 37. If it's non-adjusting, disclosure under IAS 10. If the crime's before the year end, by the way, I say provision if it's likely they'll have to pay, or it could be a contingent liability. So you know how it works. If they are probably going to lose the case, provision. If they might lose the case, contingent liability. Again, I'm not going to read what the audit senior says. I'm going to read up until the end of this paragraph, then stop. The matter has been fully disclosed. The claim is from a customer who slipped on a greasy step outside one of the retail outlets. Not entirely sure this is going to be the shop's fault, but I don't know. If the claim is in October, the year end is September. Well, whoever slipped over must have got injured, gone to a doctor or hospital, found out how bad they were, maybe found out the costs of treatment if they've had to have private health. Sorry. Has then gone and got legal advice, and their lawyers have said you should claim. I'm guessing, but if they're claiming October, I'm guessing this probably happened before the end of September. So I think it's probably before the year end, and therefore it's either a provision or a contingent liability. The matter has been fully disclosed as a material contingent liability in the notes to the financial statements, and audit working papers provide sufficient evidence that no provision is necessary. As the lawyers have said, the likelihood is only possible. Yeah, I'm going to stop in a minute and get some water, but there are only so many breaks I can take, otherwise we'll never get to the end of this. And we've only been going for half an hour, and we've still got another 90 minutes left, so I'll take a break soon. It's just, I'm bunged up. There's not much I can do about it. So, having read that story... Oh, sorry, one more sentence. The amount of the claim is fixed, so we know how much they're suing for, and is adequately covered by cash resources. So if they lose, they can afford it. What do I learn putting all of that information together? I'll tell you what I learn. In terms of the financial statements, I would say that the claim is an adjusting IAS 10 event after the reporting period, as the accident was probably before the year end. We have all audit evidence, and that's relevant because that knocks out 2 of the 7 outcomes. And the financial statements appear to be correct because IAS 37 says contingent liability if obligation is possible, which is what seems to be happening here. So the accounts are right, and we've got all the evidence, which means there's only 3 other possibilities from the 7 left. Is there a mistake in the other information? Well, the other information isn't even mentioned, so it's not that. So we've got 2 outcomes left. It's either emphasis of matter or nothing whatsoever. Well, emphasis of matter is where the auditor is going to refer to something that's in the accounts and correct and really significant. This disclosure note is correct. The question, therefore, is it significant? Well, it doesn't create a going concern threat by the looks of it. And therefore, no emphasis of matter paragraph is needed. Therefore, the answer to this one is a totally unmodified report. So just to run through that again. The accounts are right, and we've got all the evidence. So the 4 reasons for modifying the audit opinion are gone. It's nothing to do with other information, so that's gone. There is something in the accounts which is correct. It's a disclosure note, but it's not that exciting. Result, unmodified report. There's no reason to modify it at all. Let's now go see what the Audit Senior has said. The Audit Senior, top of the next page, proposes that the audit opinion for DEMA should not be qualified. I agree, it shouldn't. But that an emphasis of matter paragraph should be included to highlight the situation. Well, that bit is no, it does not need emphasising. So the question did say to comment on what the Audit Senior had said. So in my answer I need to say the Senior is partly correct because the opinion, I agree, will not be qualified, but is incorrect because of that. As a result of this, the Senior is wrong, although they're partly right. At least they got the opinion right. And having planned this, I'd now be looking at this answer and thinking I will mention the Audit Senior when I'm talking about the fact that this is not an emphasis of matter, and I'd combine the 2 things together. It's worth 4 marks. I've easily got 4 things there, more than 4 things. Hooray, done it. So notice, what did we talk about? We talked about the underlying accounting rules. We've talked about whether we've got the evidence. We've looked out for other information. And we've talked about materiality and significance. Where the audit report is modified in the first story, I've explained how it's modified. There's no reason to talk about modification in the second story because it's unmodified. And there's your answer. Now, I think I agree with Fifi. I need to go get some water, so sorry about this, but it needs to be done. See if I can survive. I've got through the other 2 classes today. I suspect 3 in one day with this voice is just too much. So I will see you in about 2 minutes, okay? So have a little refresher. Take a look at part B. When I come back, we'll have a quick look at that. Okay, back again. Been struggling this term, haven't I? Okay, so back to the question then. Now the main reason for doing the question, feel better? Yeah. Not really, but there's no choice. We have to keep on going. The main reason for choosing this question was the audit reports practice. But part B is interesting as it's a bit different. And part C is a beautiful link into chapter 7. I didn't take original last and I still had access to the mock exam. Oh, okay. That may well be true, Claire. I have to... Yeah, I don't know. I honestly don't know. But if anyone has issues with the mock exam, if you send me a mock exam through my email address, I'm sure I'll end up marking it anyway. So one way or the other, we will get you a mock exam, I'm sure. Okay then, so let's go take a look at part B. See if I'm still alive at the end of the class. So, part B. Also worth 4 marks. And since it is worth 4 marks, we are going to try and say 4 things. Always let the marks determine how much you write. B says, describe the potential benefits for Hugh in choosing to have a financial statement audit. So what we've got here is a company who presumably don't have to have an audit, but maybe would choose to. Well, if you don't legally have to have an audit, why would it be of benefit? Well, presumably, an audit would be of benefit if you are concerned that your financial statements might be wrong. Another common argument for audits is it's easier to raise finance if you've got financial statements that someone has checked. If the company think they're likely to need an audit fairly soon for legal reasons, maybe next year, year after, you could argue starting having an audit now gets you into the experience of it, understand the process, helps your auditor understand you before you actually legally have to do it. So you can sort of learn in advance. Well, those are a few thoughts. It does say the potential benefits for Hugh, not the potential benefits for anybody. So what I'm going to do is go read the story and see anything about Hugh that might suggest an audit would be a benefit. Hugh was incorporated in October 2010. Well, the first thing I notice is they're a brand new company. Now, you could use that as an argument both for and against an audit. If they're fairly new, it should be fairly simple, so don't need one. On the other hand, new company, lack of experience, maybe the audit will provide useful advice. Using a bank loan for finance. Revenue for the first year of trading is 750,000. There are hopes of rapid growth. Well, rapid growth says to me that they are likely to need more finance, and that is a good argument for having an audit. The business retails luxury handmade wooden toys, currently in a single retail outlet. Well, that suggests they don't need an audit. They sound pretty simple. 2 directors also own all of the shares, another good reason not to have an audit, because the directors produce the accounts for the shareholders and they're the same people. Are aware that due to the small size, financial statements don't need an audit, but unsure whether there'd be any benefit in a voluntary audit. The directors are also aware that a review of the financial statements could be performed as an alternative. That's part C of the question. We'll come back to that. Hugh currently employs a part-time, part-qualified accountant. Well, if they're only working part-time and they haven't passed their exams yet, that surely increases the risk of mistakes. Monty Parks, who has prepared a year-end balance sheet and income statement, now of course called Statement of Financial Position and Statement of Profit or Loss, and who produces summary management accounts every 3 months. Well, that's not very often. And that also suggests a bit of a lack of financial oversight. If you're only producing numbers every quarter, the risk of mistakes must be higher. Do they need an audit? Inexperienced accounting staff, directors focusing on growth, not on the accounts, so chance of mistakes fairly high. The fact is they'll need some finance soon for the future growth, probably. I think those are all fairly strong arguments for having an audit. There are arguments against it as well, of course, but the question doesn't ask that. It only wants arguments in favour. Part B of that question, remember this question is 7 years ago, has never been asked again. It has come up on F8, because it's more an F8 question, to be honest, but it's not come up on P7 for 7 years. Probably won't come up for you. But sometimes interesting to see a little question, only 4 marks, asking you something which is largely common sense, but not something you've probably practiced before the exam. So useful tip, if you get a little question like that, part of a question, where you're reading it and thinking, I never thought that would get asked, don't panic, stick to common sense. It's probably not very difficult. Part C. With specific reference to Hugh, discuss the objective of a review engagement and contrast the level of assurance provided with that provided in an audit of financial statements. Well, this part of the question links to the last bit of Chapter 6 and a large amount of Chapter 7. So what I'm going to do is leave the question for now, and I'll refer back to it once we get to the notes. Okay, so we'll come back to that in a little while. Let's instead go back to, where are we? There we go, Chapter 6. And the last couple of bits in here. So we're on page 88. And now we're looking at other reports. Instead of reporting to the shareholders, now we're going to be reporting to those charged with governance, otherwise known as the Audit Committee. Two audit standards on here. Both of them are revision from your F8 knowledge. The first one, ISA 265, is looking at telling your client about the internal control deficiencies they have and what they should do about them. So, as I hope you remember, the external auditor needs to review the internal controls that their client has. And if we find deficiencies, we may have to increase our substantive testing in that area. But also, if we find deficiencies, we should tell the client about them, point out the consequences, and make recommendations for improvement, making sure that our recommendations are clearly going to have benefits that outweigh costs. All recommendations need someone to do it, and that's time and money. And that is often referred to as the management letter, the report from the auditors to the client about what's wrong with their systems. Now, this does not get examined regularly on Piece 7. Largely because it's examined so regularly on the F8 exam, so it's just a reminder. But the other thing on the page has a bit more chance of coming up. It's also not examined that often, but given the Audit Committee's role has been expanding over the years, there is now an audit standard, ISA 260, that tells auditors what sort of things we should be communicating with the Audit Committee. Now, if you want an answer to this, what should we be communicating with them? There's one very easy way of looking at it. You communicate anything which is important. What does that mean? Well, there are some examples in the notes, but to be frank, the best tip I can give you on this is think audit process. Now, that is something we've done on the course, the audit process, so it shouldn't be that hard. Before we start the audit, we have to consider any ethical issues in saying yes to this client. Once we've said yes, we plan. We then assess controls. We then get evidence. We then review and report. Now, in fact, review is a dangerous word at the moment, so let's get rid of that and call it finalisation. So if this question comes up on the exam, ISA 260, why do auditors communicate with those charged with governance, aka also known as the Audit Committee? I would think audit process, and I would simply list all the important things at each stage. What do I do at the ethical stage? Well, the most common exam question, threats to objectivity and safeguards. So I will discuss those with the Audit Committee before I accept the audit. Planning. I'm thinking at the strategic level, things like time frame for the audit, will I need any experts, to what extent will I rely on the client's internal auditors. All of that I would discuss with the Audit Committee as I'm planning the audit. The detailed audit plan will cover things like audit risks, materiality, and I'd discuss those with the Audit Committee as well. Controls, well, we know we're going to report on those, but that's covered by the other audit standards, so no need for that in 260 because it's suitably covered by Audit Standard 265. Then I go get my evidence, and I'm thinking what can go wrong in there, what would I want to discuss, if there's any problems in getting hold of some evidence, I would tell the Audit Committee. And also, if I find material misstatements, I should mention them to the Audit Committee. Even if the Finance Director says, oh yeah, fair enough, I'll change that and put it right, still tell the Audit Committee so they know those mistakes were there. Finalisation, what do we do? Things like, are there any going concern threats? Management representations. And at the reporting stage, I would discuss my proposed audit report with the client. So all I've done to answer that, my technique for not having to memorise it, is what do I discuss with an Audit Committee? Absolutely anything important that happens during the audit. So just think about the audit process and that will tell you your answer. Fantastic. And that leads on to the very last bit of the chapter, other reports. And these are the reports for the non-audit assignments coming up in chapter number 7. It therefore provides a very nice link. As it says at the top, whatever assignment we carry out, there's likely to be a report at the end. And all this part of the course looks at is how would the reports be different? Well, the addressee might not be the shareholders, or rather depends on what this report is and who asked for it. It might be the shareholders. We might want to put a liability disclaimer in. We do put those into audit reports in the United Kingdom. Whether we are putting a liability disclaimer into this report, this other assignment, all depends on negotiating with the client, as you'll see in a little while. And we have a bit of a problem, because if I'm a firm of accountants, if my name appears on anything and there are numbers, the natural assumption people make is that my staff have audited this information. So if we're not auditing, my report is likely to make it very clear that we have not audited. Now you'll notice that I've missed out the second point, and there's a reason for that. I want to do the second point last. Now hopefully you remember this from F8, positive and negative assurance. I'm going to remind you, because on F8 it's a fairly small issue, for P7 it's much more examinable. So let's take a look at this. When we do an audit of financial statements, we are required to do very detailed testing. The ISAs require us to do this, and the reason we have to do it is to get a high level of assurance, known in auditing, of course, as reasonable assurance. So in an audit report, it will typically say we planned and performed our audit so as to get sufficient appropriate evidence to give reasonable assurance that the financial statements are free from material misstatement, whether caused by fraud or error. And because we have done detailed testing and therefore have a high level of assurance, the result is the auditor is quite sure, i.e. positive, in his or her opinion. And because we feel relatively positive, we are going to say the financial statements, in our opinion, give or do not give a true and fair view. Or we will say, except for that, the financial statements give a true and fair view. And all of that is positive. Whatever opinion you give in an audit report, you sound sure. However, there is another type of assignment called a review. Now that review might be a review of accounting information, of financial statements, or it might be a review of virtually anything else. But the word review is important. Because I know it doesn't sound like it, but it is a technical term. And what it means is an assignment, a bit like an audit, I suppose, but now you're doing less detailed tests. Now, there are all sorts of reasons why you might be doing less detailed tests. It could be that there is no legal requirement for this assignment and the client doesn't want to pay for detailed tests. It could be that the client ideally would pay for detailed tests, but there's not enough time, given the client's needs, to spend the time doing the detail. It has to be quick. And sometimes the reason it's not that detailed is detail is impossible. Because there are some things you simply can't check in detail due to their nature, as we'll see shortly. Because it's less detailed, we are going to have a lower level of assurance, meaning our opinion, because we're not so sure, so we use negative language. So now what we say is something like, nothing has been seen to suggest the figures are not true and fair. So it's negative. Oh, no, 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 no. Sorry, just give me a minute. I've made a complete mess of this. Nothing. So there we go. Negative. Nothing and not. So that is a review assignment. Now, in the exam question we were just doing, the final part of the question was asking, why might Hugh prefer to have a review assignment instead of an audit? Let's just go back and take a look. Prove I'm not making this up. Part C, with specific reference to Hugh, discuss the objective of a review engagement and contrast the level of assurance provided with that provided in an audit of financial statements. Well, if you don't need an audit legally, you might not want to pay for the detail. Also, given that Hugh is owned and managed by the same two people, and they're still relatively small and relatively simplistic, you could argue that the detailed testing maybe is not required. And if that's the case, a review of their financial statements, a less detailed assignment than an audit, might be enough to give the directors and owners some assurance that the accounts look sort of okay, and might be enough to convince a bank that they're worth lending money on. So it's a sort of halfway house between no checking at all and a fully detailed audit. So that is a review. As I've said, the question is review of financial statements, but potentially, sorry about this, potentially you could review pretty much anything. So an audit is whenever you do lots of detail. A review is a less detailed form of audit. What do I mean by less detailed? Well, you remember in audits we do A, E, I, O, U, 5 types of testing. So an audit does all 5. With a review assignment, as we will see in the notes shortly, we focus on analytical and enquiry. And that's it. Right, fantastic. Well, that is the end of chapter 6. It's also a beautiful introduction to chapter 7. I'm afraid I'm going to have to go and have a 2-minute voice rest and go and get a little bit more water. The main problem, to be honest, is the voice needs a bit of rest because I'm ill. It's struggling to cope with the number of hours. So just give me 2 more minutes, and when I come back, we will go through to the end. All right, 2-minute break. Make the most of this. You don't normally get breaks with me. I will see you in a minute or 2. Okay, folks, Mr. Ill is back again. So then, we have just been looking at different levels of assurance, positive and negative. Positive comes with high level assurance, negative with lower level. Lower level assurance, where we're doing less detailed testing, commonly known as a review. So having now looked at all of that and applied it back to the question, it is now time to head into Chapter 7. As we head to Chapter 7, we'll go past the end of Chapter 6, where there are some example audit reports. There is one of those I need to refer to. They're just there for you to be able to have a look at and get a feel for how they work. Example 4, which starts on page 96. If you just go over onto page 97, this is an emphasis of matter. And what you may find odd about this is that the matter being emphasised, which is here, see, refers to note 29. Our opinion is not qualified, so unmodified opinion with extra paragraph is the paragraph looks like it's in the wrong place. At the time this audit report came out in the UK, it was in the right place, but the rules changed a few years ago, and this paragraph should now go below the opinion. Okay, I decided to leave it there. I don't like changing someone else's document, and this is an audit report, a real one, written by a firm of auditors. So rather than play around with it, I left it and just explain it each time. Okay, apart from that, I will leave you to look at the examples. They are there in case you are not the sort of person who reads lots of audit reports, as most students are not. Let's now go into Chapter 7 and other assignments. So this is where we are not auditing the financial statements. We are doing something else. Now, you could be asked something technical about one of these other assignments. What does it mean? What's it all about? But as we're about to see, there is a common exam question here. The syllabus content is perhaps interesting here. We start off looking at the nature of assurance and the different services, and then we get into some examples. Prospective financial information is looking at the future. So instead of checking last year's financial statements, we're now looking at checking some forecasts. Forensics is all about work we do that is linked to court cases and other forms of legal dispute. So, simple example, an insurance company might hire a firm of accountants to check an insurance claim being made by one of its customers to make sure the claim is valid. Internal audit, well, you know what internal auditors are, so there's no need to say anything about that at this point. Outsourcing, where companies pay outside experts to do work for them, which could of course be us, but there is an implication for the audit process here, and that's probably the more examinable point. And then the audit of performance information in the public sector. This is new for P7 from the December 14 sitting, which might tend to suggest it's got a chance of coming up. Now, there's no guarantee it will come up. Public sector stuff has been appearing in a lot of the ACCA's exam papers, including P1, suggesting the ACCA is trying to target people who work in public sector to do the ACCA qualification. No guarantee the examiner cares that much about it, but it's on the syllabus, so we need to take a look. Okay, let's get past the contents and look at the exam questions. Because there's a very common question type that comes up here. And it involves asking, first of all, what should you think about before accepting this piece of work? Now, of course, if I said, what should you think about before accepting an audit client? Well, you know about that, don't you? We'll remind ourselves in a minute. But what if it's not an audit? What should we think about? Different levels of assurance we've just looked at, the second point. Types of report, we've sort of mentioned that already. But the other popular exam question element is to say, what should you consider before accepting this? And now you've accepted it, how would you do it? So how do you do a forensic audit? How do you check forecasts? What do you do in a due diligence review? So the actual nuts and bolts, the testing, the audit procedures. Right, before we go any further, let's come out of the notes. And let's use this as a chance for some revision. If I asked what would you consider before accepting an audit, hopefully you'd think of things like this. We ought to make sure we are competent to audit this client. We ought to assess the threats to objectivity that exist. We should consider the integrity of the client. And whenever I see that, I remember it's I of C, and that reminds me of C of I. We should consider any conflicts of interest with other clients. We should consider whether the fees are enough to cover the risk involved in doing the work. How long is it going to take? What are the client's deadlines for doing it? Have we got the staff and other resources necessary? Financial health of the client. Because I don't want to take on clients if they're not going to pay the bill. And I suppose I would also consider the need to do professional clearance. In other words, contact the outgoing auditor to see if there's any issues, interesting information I ought to know. And one more maybe, what else should I do? I should see if the preconditions for an audit are in place. Now, the preconditions for an audit, just to remind you, are things like, are they following some accounting standards? One hopes the client is. Will they provide the evidence? And have they got some controls in place to protect the financial statements from too many mistakes? Now that really is an F8 exam question. It can come up on P7. And there are some examples of many of the things we have to consider before accepting an audit client. That is back in chapter 3 of the class notes, by the way. We saw that ages ago during the course. My question, though, is this. How many of these items are going to be relevant if we're not doing an audit? So what if the client is asking me to do something else? Okay, let's have an example. Let's imagine our client wants us to check their business plan and give an opinion on whether we think their business plan's figures make sense. Before we say yes to this, would we have to consider if we are competent to do it? Yep. Would you care about the fees? Yes. Would you care about the risk? Yes. Would you care about how long it's going to take and whether you can meet your client's deadlines, and do you have the staff available, and will the client pay the bill? Yes, 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 yes. Do you care about threats to objectivity? Well, the answer is, if I'm ever giving an opinion on anything, I want to be objective. So as long as there's an opinion, yes. Integrity of the client, someone you can trust? Yes. Conflicts with other clients? Yes. Professional clearance, talking to the outgoing auditor. Well, if a company has come to me and said, we don't need an audit, we've already got auditors, but we need someone to check our business plan, is it worth contacting the outgoing auditor? There is no outgoing auditor, the auditor is staying put. Okay, fine, cross out outgoing. Would you like to talk to their auditors? Is there any benefit in that? Might they have useful information that will help you to assess this business plan? They might do, yes. Clearly, we don't need the preconditions for an audit to be in place if we're not doing an audit. But even if we're not doing an audit, if we're checking anything, do we need to check against some standards? Yes. Will we need some evidence? Yes. And do we need to understand the system that has produced the figures that we are to check to see if the system looks reliable? Yes. It turns out it doesn't matter whether you are being asked to do an audit or anything else. Everything you know about considerations before accepting an audit is relevant to every other assignment as well. So I suppose the first thing I would say is that other assignments are close enough to auditing that one way to get some marks is to pretend they are auditing. I mean, as I've already said, what is a review? It's an audit. But it's the A and the E, the analytical and the inquiry, but not the IOU. So it's part of an audit. So don't get overexcited by this chapter. It's not that different. It's just you're checking something that's not the financial statements. That's all. Checking is checking. Okay then. Well, on page 104, it has exactly what we've just done. But it's the sort of thing in the course, a bit like the group audit chapter, where reading the notes doesn't help. Practicing the notes is what you need to do, and that's what we just did. So there we have some factors before acceptance. I think we got pretty much all of those. But the interesting thing is down at the bottom, and this you need to learn. You see, if I'm doing an audit of the accounts, there are some things I don't need to worry about. I don't need to worry about what should the report look like. Audit standards tell me. Who will I report to? The shareholders. It's the law. How much testing do I have to do? Enough to get sufficient appropriate evidence to give reasonable assurance. It's the rules. Will all the evidence be made available? Yes. Client has to. It's the law. Basic rights of an auditor. Who am I liable to? The shareholders. And you can avoid liability to everybody else with that disclaimer in your audit report. Who produced the accounts? The directors. Because it's the law. Why did they produce them? Because it's the law. Why am I auditing them? Because it's the law. So many issues are just irrelevant because they're fixed. If your client is asking you to do something which is not an audit, then you need to bear in mind that all those fixed things are probably not fixed. What will the report look like? Between you and the client to agree. How will you do the work? Up to you. How did they come up with these numbers? Good question. I've no idea. There are no accounting standards to follow. How much evidence are you going to get? I don't know. Ask the client how much they'll let you see. Agree something. Can you put a liability disclaimer in your in your report? I don't know. The client's paying for it. Talk to them. So if I am accepting an assignment which is not an audit, there is a long list of additional things I need to agree with the client. That's what's on the screen at the moment, and that is the critical bit. You need to learn it. Now, if we just look down towards the bottom of this list, is there any professional guidance available? An audit has got ISAs to follow. But it is worth noting that some common non-audit assignments have standards. So there are some additional assurance standards as well as the audit standards. So if you're checking forecasts, for example, that has got some guidance to follow. So if you want to follow it, follow it. But it's not like audit standards where there's about 30 different standards for the process. If it's not an audit, the best you're likely to get is one piece of guidance, and it won't be very detailed. Okay, so that's important stuff. And if you're doing more than one assignment for a client, separate engagement letter for each. It's like a separate contract. Page 106 is what we were looking at earlier, different levels of assurance. So audits, detailed, high-level assurance, positive language in the opinion. Review assignments, which is really what this chapter is largely about, less detailed. The A and the E instead of the A, E, I, O, U. And a review report will have negative assurance. Nothing has come to our attention that causes us to believe the accompanying information does not give a true and fair view. As I said earlier, because we've not done a full audit, the report will say we have not done an audit. It is less detailed to try and make it absolutely clear that we have not checked the figures in detail. Now, all of that is delightful. Top of the next page, we have some examples. So, reviewing a business plan. Due diligence, so when one company is buying another, it wants to check that company out, and it may well hire people like us to go and do some of those checks, as we'll see in a little while. But also, listed companies produce their accounts once a year for audit, but also tend to produce half-year and, in fact, quarterly accounts. And if they're going to produce accounts during the year for shareholders to see, it is common to have these reviewed. So the auditors come in partway through the year and check the interim figures that the company is already disclosing. More detail coming up shortly, but a little bit of technical stuff now. And maybe because it's technical, all of this stuff down here, down to the bottom of the page, is less important for the exam, so we get to go through it fairly quickly. Agreed upon procedures are where we do something for a client, but they don't want an opinion. In other words, we're not checking anything. We're just doing what our client asks us to do. Now, one example of that is something called a compilation. So, for example, if your client says, hello, we don't need an audit, we've got auditors, but our whole finance department has gone down with the flu, so can we hire you guys to take our accounting records and turn them into a set of accounts? Yeah, we can do that. We're accountants. Clever we are. Thing is, you're not going to be checking the numbers. So if in their accounting system it says revenue 5 million, you're not going to check that. You're just going to take that 5 million figure and put it at the top of their profit or loss. You're not checking the numbers. You're just putting them in the places they're meant to go. Compilation is taking information and reordering it into the format that someone wants. So there's no checking whatsoever. So when you put your name on these accounts, you will need to make it very clear that you have compiled the figures for the client, but you have not checked anything, and as such, there is no assurance provided whatsoever. So what have we seen so far? An audit, high level, detailed testing, high level assurance. A review, less detailed checking, low level assurance. A compilation, no checking at all. No opinion, no assurance. Audit-related services just highlights the fact that in many cases, a company will ask its auditors to do things like a due diligence check on a potential target, to check business plans, because frankly there's no reason not to, and your auditors already understand you, so it's probably quicker and more efficient to use them than it is to use another firm. Down at the bottom of the page, this is really not very important. So let me just, let me just extend that red arrow all the way down here. Attestation and direct reporting. Let's imagine a company puts out a statement saying, we comply with industry standard number 5. Well, that is an assertion. We might now go in and check that what they're saying is true, and that's called attestation. Checking that an assertion that someone makes is true. Let's now imagine another company. They've not said anything, but there are rumours that they are dumping stuff into a local river. The Environment Agency phones up your audit firm and says, we want you to investigate whether this company has been dumping stuff into the local river. This is direct reporting, because now you are reporting on a company to someone else. Your client is the regulator, not the company. Now, it's not a major issue, but it will change the way you do the work, because if you're investigating a company but they're not your actual client, getting access to evidence could be extremely difficult, because they didn't invite you to come and do this. The regulator did. Apart from that, though, there's nothing to know about it. I've been teaching for 19 years. I've seen that come up once for 2 marks. So realistically, will it come up for you? Probably not. However, something that will come up for you probably is one of the examples in this chapter. So let's start off by thinking business plans and forecasts. How would you go about checking forecasts? Well, it's a review, and reviews are A and D, analytical and inquiry, so that's our starting point. Let's think analytical, comparing. Well, I suppose if I gave you LSBF's forecasts for next term, an obvious thing to compare them with would be this term's numbers. So compare the forecasts with the most recent trend in the actual figures. We might also go and check LSBF's previous forecasts and see how well they turned into actuals. That would give us evidence as to whether LSBF are good at coming up with forecasts, if they are good at estimating. If there's an industry magazine, and in our industry there is an industry magazine, just like there is in most industries, I'd be tempted to read it and look at the industry forecasts and then compare your client's forecasts to the industry. See if it's in line with how people think the industry is going to go. You should also compare the numbers in the forecasts with each other. Make sure they make internal sense. So if sales are forecast to grow by 10%, cost of sales should grow by 10%. Any selling related costs should be going up. They might need more staff, so staff costs should go up. And if you're selling more, wouldn't you have more receivables at the year end, more inventory? So there are some examples of the sort of things I would compare. I also need to enquire of management what assumptions are these forecasts based on, and then assess those assumptions to see if they appear reasonable. I can also compare their assumptions with fact. If they say we're assuming 10% sales growth because we're about to do a marketing campaign, look for evidence of the marketing campaign. If they are putting together a business plan, if it has a cash flow statement, well, that's fine, that's cash flow. But if they're doing a profit forecast and a forecast statement of financial position, you will also need to check the accounting policies that they're using in the forecasts are the same as the ones they're using in the accounts. So things like depreciation, for example, would need to be in forecasts if it's profit and statement of financial position. Obviously, depreciation is not a cash flow, so it's not going in there. So, I've talked about comparison, asking management about any policy changes they're going to put in place, if they're aware of any legal changes coming up that would change the way the company operates, and making sure the forecasts have taken those into account. But one interesting thing about forecasts is this. If I handed you now the LSBF forecasts for the next 6 months, a lot of the things that are happening in those forecasts are not estimates. They're fact. I'm currently standing in a building. This building has a lease which is longer than the next 6 months, which means we already know the rent we're going to be paying for the next 6 months. It's a fact. This company has tutors like me. Hello. And we get paid, which is quite a relief. Thing is, I already know what the salaries of the tutor team will be next year because it's already decided. And then there's the business rates you have to pay, and your utility bills, and your insurance, many of which are either paid in advance or would be so similar to last year, they're not really estimates at all. And then there's sales. Some of our students who will study with us next term have already booked. They might not know specifically which papers yet, but they know they'll have papers left. They've already booked, largely to try and beat any price rise they think will happen at the year end. And also I can use current sales figures to guess what next year's will be, because most students will tend to stick with the college term after term, so you can sort of track people through the system. If you've got a lot of students doing F8 this term, most of those will be doing things like P1 and P2 next term. So as it says at the bottom here, it's not just A&E. A lot of numbers in forecasts we already know. We may have placed orders for new assets and got quotes. It's a bit like if I looked at your personal forecasts and you've put a holiday in there, there's every chance you've researched the holiday, got a quote, you may even have booked it and paid for it already. So with forecasts, we will do comparison, analytical. We will ask questions of management to try and understand their forecasts, and then we'll look for evidence for those things that are already fixed, as a lot of things tend to be. Now, being able to check forecasts is a very useful skill, Because a second potential exam question, due diligence, also will include the checking of forecasts. When a company is taking over another company, what should it check? Well, of course it wants to check the accounting position. But a lot of that's surely been done already, because as long as the target has an audit firm, their most recent accounts will have been audited. Now, fair enough, since their last year end, time will have passed, so one thing I'll need to do is check their accounting performance between their last year end and today. So I will need to check the target's management accounts since the last year end. But if you are buying a company, you are buying it largely for its future potential, and therefore all that stuff we just saw about forecasts will be part of due diligence review as well. But a far more important thing to check when buying a company is this. Imagine you're getting married. Before you get married, it would be a very good idea to check the person you're getting married to. You know, little things like they're not already married. But also consider this. Imagine you've got a boyfriend or girlfriend and they always have really nice hair, they dress well, they smell good, they're wearing very nice expensive perfumes or aftershaves. They drive a nice car, got a nice apartment, go on expensive holidays, wearing nice jewellery, wear a good watch. And you're thinking, lucky me. Not only do I really like this person, but they are clearly got loads of nice stuff. Well, if that person has a good job and a source of income and they're paying for all of this, that's fabulous. Lucky you. What if they're not paying for it? What if the nice clothes have been borrowed from mum or dad, or paid for by mum or dad? What if the car is dad's car, mum's car? What if the apartment has been bought by the parents and is being rented for free to the child? Well, you know what? When you marry this person, I'm guessing the parents are going to expect you to be paying for cars, apartments, clothes, nice hair, jewellery, etc. It's the same with companies. Some companies can look very attractive until you realise how much the current parent is putting into that company. Take them away, what have you got left? Often a subsidiary will live in the parent's head office, possibly rent-free, possibly using the telephone system, the IT system, the email, the canteen, the receptionist, all for free. Well, if you buy that company, you've just bought a company with no building, no IT system, no phone system, no receptionist, no photocopier, no canteen, no coffee machine, no kettle, or anything else. So one of the main things to check when you're buying another company is what do you actually get with it and what will you lose on the change of ownership. Now, linked in with that is often when you buy a company, a lot of contracts that the company has will have clauses in them that mean the contract is dead on a change of ownership. So things like employee contracts, customers, suppliers, lease agreements, any of those could disappear with a change of ownership. I mean, I'll give you a good example of this. LSBF is an approved learning provider with ACCA, and one of the things that ACCA checks is they do a credit check to make sure that the company is financially stable. If there's a change of ownership of LSBF, ACCA will have to recheck the credit of the new ownership, which means potentially you buy a college that's an ALP and then you lose ALP status because you, the new owner, are not financially viable. That would be a bit annoying, wouldn't it? Imagine you buy a football club only to find that they don't actually own their stadium, they're leasing it from the local authority who've now decided they don't like the new owners, so they won't lease it to you. You've got no stadium anymore. What if some of the senior players only ever signed for that club because they liked the owner? And now they're saying, new owner, I'm leaving, bye-bye, because in their contract it says they can. So with due diligence, you need to check contracts very, very carefully. Other assignments that you might be asked to do. E-commerce, less likely on the exam. There was a time about 10, 15 years ago as companies started selling stuff on the internet when this was far more interesting. Of course, everyone sells on the internet now. And I think pretty much all of us are aware of the sort of issues that would need to be checked. Antivirus software, do they back up their data to avoid losing it? What do they do to check the ownership of customers when you're buying and selling things online? Can't see the other person. Making sure you're meeting the Data Protection Act, avoiding hacking, etc. But as I said, less likely to come up these days, not really so exciting. Far more examinable is forensic work. And there is a recent article in the P7 section of ACCA Global on this very subject. Forensic auditing is simply auditing, except now you're checking stuff not for the accounts, but checking stuff to create evidence that would be used in a court case. Sometimes a company will come to you and say, look, we don't just want you to get paperwork, we want you to interview our staff and try and find out what's gone on. If you would like a really good example of this, we've got one at the moment, thanks to our friends at Tesco's, because they have got a forensic investigation going on at the moment, being done by Deloitte, the accountants, and Freshfields, the lawyers, to try and work out what's gone on with that £250 million overstatement. So if you want a better idea of forensic stuff, go take a look at that. Look it up on the internet. There's loads of articles about it. So forensics is, to be honest, just auditing, but for a very specific purpose, not checking the accounts for the shareholders, checking information that might well end up in some sort of legal dispute. And Deloitte and Freshfields will be well aware that the information they're putting together might end up resulting in a criminal prosecution and might end up in their staff having to stand up in court and defend this. So forensics has got a few issues. I suggest you learn those because those are potentially quite examinable. Claire, I refer you back to what I said at the start of this evening. I will be posting exam tips on the platform tomorrow. I don't want to spend class time doing it. We have limited class time. The tips will be very obvious when I've explained them, so it's just a list. And frankly, reading it out is just wasting class time. Ouch. Ooh, sorry, I've impaired my hand. In terms of tips in general, you may remember PQ Magazine. I mentioned it right at the start of the course. They will be publishing all of the tips from all of the colleges, including us. In fact, I've just reminded myself that by the end of this week, I need to send to PQ Magazine all of the tips on all of the papers. No problem, Claire. Internet issues, I am aware. It happens. Social and environmental audits. Now, the fact is, companies have been producing social environmental data for years. We're moving now towards integrated reports, and lots of companies are doing these now. Integrated reports where it's not just separated financial, social, environmental, but some companies are piling all of this together into one single report. That necessarily means that us auditors are going to be asked to check this data much more than we have in the past. Typically, there's no legal requirement to check it. It is other information, unaudited. But going forward, there are arguments that we should be giving opinions on this stuff as well. That creates a potential exam question, and it's been tested several times in recent years. And it's these first two bullet points on the next page. Suggest some KPIs for social environmental, and then what evidence you would get to check the KPIs are accurate. Examples. KPIs. Well, social. I guess with social we are talking about people, so think stakeholders. That immediately gets me to think of people like staff. So KPIs to show how companies deal with their staff could be things like employee turnover rates, and maybe the amount of dollars per staff spent on training. Customers. We could look at levels of complaints or retention rates. What percentage of your customers come back and use the company again? In terms of community, we might look at things like amount spent on charitable donations. Environmental, some fairly obvious ones here, things like the percentage of waste that a company recycles, the amount of water used, electricity, the amount of pollution generated. And if I told you, having suggested those KPIs, that your client has taken up your suggestion and is now publishing those numbers, maybe next year they'll now ask you to check their numbers are accurate. How would you do that? Well, employee turnover would be easy enough. You'd just look at personnel records. Amount of money spent on training, you could look at invoices. Charitable donations, letters to and from the charity. Water use, electricity use, look at the bills. So, not exactly that complicated to come up with the evidence if you can think of KPIs. And the nice thing is about all of those KPIs I've put up there, doesn't really matter which company comes up on the exam, any of those KPIs are likely to be relevant. Now, of course, if you get a specific company, try to be specific. If you get, I don't know, a sports club, then the number of injuries to players could be seen as a social issue. A sports club, you might look at how often they let the local community use their facilities for free. That's an issue. If you're looking at an oil company, obviously environmental is going to be an issue. Look at things like the number of barrels of oil that have been spilled this year. So use the company where you can, but a lot of social and environmental issues are the same company by company. Accidents at work, health and safety, training for staff, all going to be relevant to any company. Moving onwards, internal audits, not much to say about that. We know what internal auditors do. We did look at reliance on internal auditors back in Chapter 4. We are about to look at it again as we come towards the end of the course. More on that shortly. Outsourcing of internal auditors, there are pros and cons, good things, bad things, and you might be asked that. But to be honest, this is more an F8 level question than it is P7, so it's got a chance, but relatively small. We do, though, need to look at this bit down here. Outsourcing and the impact on the auditor. Let's imagine that you are an audit firm and you have a client who we shall call Client X. But Client X have outsourced their payroll to a company called Payroll Services Co., or PSC. Now, your problem here as auditor is if you're auditing your client's payroll figures, number one, you need to get hold of their documentation, which might be at Payroll Services Company, but that's fine because you can ask your client to arrange for the paperwork to go back. You have a right to see it. They have to say yes to that. So substantive testing will be easy enough because you can get hold of the documents to check the numbers. The difficulty is if you want to assess the controls over the payroll, surely you need to assess PSC's controls, because they're the ones doing the payroll, so it's their controls that will determine whether your client's payroll figures are right or not. Well, that causes a problem, because how can you assess controls at a company that's not your client? You've got no access to their systems. Of course, you know someone who has, because assuming they have got auditors, the solution here is to get a report on PSC's controls from PSC's auditors. That is what Audit Standard 402 covers. It is the least examined audit standard of all of them, because it only ever applies where your client is outsourcing. Otherwise, it's irrelevant. It's very small, but it can come up on the exam. Lights, please. Excuse me a minute. Excuse me. You've just turned off the lights. I'm live on the internet. Thanks very much. Cheers. Thank you. Oh, the amusing. I know you can see me, but it does affect the quality of the lighting on the recording especially, so we do need them on. We've got a studio here carved into another room. The light switches are in the office next door. So it has happened before. Apologies. Anyway, back we come to this. Okay, so where were we? So ISA 402, an audit standard that only applies when your client has outsourced something. Okay? Good. Almost finished. The last thing in this chapter is new, or at least it looks like it's new, on the P7 exam, except it's not new at all. The issue here is this. When companies are public sector, in other words, they're using state funds, so government departments, nationalised industries owned by the government. Because they're using taxpayer money, there's a lot of pressure for them to be accountable for how they use that money. So we'd normally expect public sector to disclose all sorts of operational information to show that they are being efficient and effective and economical in the way they use this money. But then, you've heard of that before, haven't you? Because that is on F8. So you could get a question very similar to the social environmental stuff, as I've just noted, where again you're asked for KPIs and evidence, but now it's not social environmental, instead it's economical, efficiency and effectiveness. So for example, let's imagine that in your country the national airline is owned by the government, so it's funded with taxpayer money. To help identify how well taxpayer money is being spent, the airline has been told it must publish some data, and you've been asked to recommend what it should publish, and then when it publishes it, to check the data is accurate. Well, if you're an airline, economical, we need to look at what your big costs are, and your big costs are going to be the price of fuel per gallon, I suppose, the price of the aeroplanes, they're going to be fairly expensive, and I suppose another big cost is going to be staff costs. So for example, pilot salaries. And what you might do to show that you're being economical is maybe benchmark those to industry averages. And you might say our pilot salaries are approximately 3% higher than the airline industry. Then, as the person checking this data, I'm going to have to check your pilot salaries, easy, check the payroll statistics, and then find out what the industry average is, which presumably can be found in industry journals, industry magazines. Price of fuel, easy enough to find out what the company is paying. Average price of fuel, again, industry magazines should be able to tell you that. Efficiency. Now we look at the resources and how they get used. So you might look at things like miles per gallon of fuel. See how fuel efficient the aeroplanes are. You might look at how full of passengers the aeroplanes are. You might look at the ratio of staff on the aeroplane to passengers. And in terms of effectiveness, what's an effective airline? How many flights turn up late? Customer retention. You might even look at things like industry awards. Because if you're winning awards, it suggests you are doing a good job. What we're looking at here is exactly the same as the social environmental, except the nature of the KPIs is now different. It's more financial because the public sector needs to be shown, or needs to show, sorry, that it is using taxpayer money wisely. Of course, the public sector also needs to show it's social and environmental. So I'm wondering if you might get an exam question this time that requires you to come up with social, environmental and operational 3Es, efficiency, economy type stuff, might all be in there. Anyway, it's not difficult to do the evidence if you can come up with the KPIs, and the good news is the KPIs are going to be pretty similar for many types of business. Right, well that was chapter 7, and that leaves us just with this, chapter 8. And with chapter 8, I suggest you read it. I also suggest you visit the IAASB.org website, part of the International Federation of Accountants, and you go look at what's going on at the moment. Now, I'm not ducking out of this, don't worry. But the thing is, I had to write these class notes before the last exam was sat in June. And the problem with that is that these issues are not as current as I would like them to be, because they can't take account of what came up last time and can't take account of what the examiner articles have been writing about in recent times. So I will let you read the chapter, and instead I will finish today's course by putting a couple of current issues up on the screen. Current issue, Audit Standard 610, reliance by external auditors on the work of internal auditors. This is a current issue because this audit standard has been updated twice in the last 2 years. There has been a bit of concern in the audit industry that some firms of external auditors are over-relying on the work being done by other people, and because they are over-relying on it, they're not doing so much work themselves and they're losing that client understanding as a result. With ISA 610, there are two main themes to be aware of. Relying on work that internal audit did in the past, e.g. controls tests, because internal audit likely to be doing those all year long. And the other issue, which is far more important for the exam, because this is the big thing which has had changes in the audit standard, and this is, can the external auditors use the client's internal audit staff in the external audit team? Actually borrow staff and get them to do some of the external audit work. Relying on internal audit work done in the past, well, this is pretty straightforward over here. All you've got to do is assess if the internal auditors are qualified, experienced, and independent, just like any other expert really, and you should review their work before you place reliance on it, and that's likely to include repeating a sample of some of their work to make sure you come to the same conclusions. But assuming that works, sure, if they've done controls tests, you would do controls tests in pretty much the same way. But the far more interesting bit is the other side. And the answer is yes, you can use the client's internal audit staff to help you do external audit work, but only if there are no laws preventing it, because in some countries it might be legally banned. You would have to check their competence to do the work. You don't use them on anything which is considered high risk, subjective, so things like estimates, not on third-party confirmations, not on anything to do with your assessment of fraud, largely because it's high risk and subjective, and not on any area where they have work involvement at the company. As long as all of that is true, you can use them, but you must discuss the extent of the reliance with your client's audit committee, as we noted earlier when looking at Audit Standard 260. And you will need, because they're now part of your audit team, to direct them, supervise them, and review their work. Because let's face it, whilst their independence is potentially a risk, they will know the client and therefore potentially are valuable members of the audit team as long as you keep them off anything where there are risks. High level, high risk, subjective areas, that is what you are there for as external independent auditor. But if there's some lower level work where their knowledge of the company could be useful, if you feel the risk is worth taking, you can do it. So there's one potential exam question. Will it come up? Maybe, not sure. But the other area, which is highly current at the moment, is the fact that we have coming in to play a new format audit report. Now, I'm not going to take you through what's in that new format audit report. No, I'm not. Instead, I'm going to tell you that there's an article, again on the ACCA Global P7 section, that covers this, and I recommend you go look at it. But a far better way for us to study this as we finish the course is to go look at what one of these will look like. Because some audit firms are already using it. They are trialling the new format. And would you believe it? But one of the examples of this is PwC's audit of Tesco. And isn't that a lovely example to look at? So Tesco's are halfway through their current accounting year, but their previous one ended February, I think it was, 2014. And if you go to their website, you can find their annual report, and included in it on page 65 of the Tesco's annual report is the audit report. So instead of doing this in a very theory-based way, let's look through the audit report and see what's interesting. Okay, first thing we notice. The opinion is now first. To help give it more prominence, instead of being at the end, it is lifted to the beginning. Apart from that, it's the same old opinions, but just at the start. After the opinion, it then talks about what's been audited, all the same usual stuff there. And down at the bottom, there is now increased detail, re the auditor's duties for checking the other information. Now, it should be noted that the audit standard on other information, ISA 720, is being redesigned at the moment to fit in with enhanced responsibilities. We're going to end up doing more on the other stuff in the annual report. Not a surprise, it's been on the cards for years. At the top of the next column, there is an overview of the audit approach. This is much more detailed than in the past. Look at this. We are now telling people what the materiality figure was and how we calculated it. So for Tesco's, 150 million, 5% of profit, as you might expect. It also talks about reporting smaller errors to the audit committee. So as we know, at the end of the audit, we report to the audit committee any other mistakes that haven't been changed, probably because they're small ones, but we still report them. Overview of the scope of our audit is very much talking about the client. So there's an increase in the client focus of audit reports now. It's A lot of complaint in the past that audit reports were very standardised and barely changed from client to client. Much more client stuff in there now. If we go down onto the next page, and one thing immediately to notice is there is a next page. This audit report is a lot longer than it ever used to be. Much change here. Now we are going to talk about the difficult, the subjective, problem areas of the audit. This is going to give a lot more interest to shareholders about how the audit took place and what the troublesome issues were. And given it's Tesco's, would you believe it, the very first thing is what's causing them trouble at the moment. I love this. Well, you can't blame PwC for not realising this was a risk. Interestingly, when they looked at it, they said it was okay. Of course, we now know it's not okay. Just goes to show, doesn't it? Other areas of interest on the Tesco's audit: impairment of property, plant and equipment. Obviously a lot of assets, a lot of buildings, because they're a supermarket group. Valuation, subjective. Provisions, subjective, they're an estimate. Management override of internal controls. I love the fact that Tesco's assessed the control environment, including whistleblowing, which is exactly what's just happened. So I suppose at least the whistleblowing policies at Tesco's seem to work. If people think someone's being naughty, they will tell someone, and eventually they'll get listened to, although not at first, apparently. The risk of fraud in revenue recognition. Because of the pressure management may feel to achieve the planned results, and whether they were recorded in the correct period. Exactly what's now gone wrong. So I suppose at least if PwC get complaints about this, they can say they were well aware of the issues, and last time they checked it, everything was fine. At least they understand the client, so you've got to give them that. The audit report then goes on and on. We've now got a section about going concern, but this bit was examined in the June paper. So if audit report format does come up, I doubt it will be the going concern bit. So I won't say anything more about that. And look at this. There is now an opinion on the other information. At the moment, you only say anything if it's wrong. In the new format, you will say whether it's right or wrong. You'll always mention it. Expanded responsibilities. So as you can see, the new audit report is very different to the old one. It is longer. It is more client specific, which means every audit report is likely to now be interesting to read. It focuses on the key audit risks, the risks of material misstatement, which makes these new reports a very useful education aid for P7 students as well. Okay. Well, my friends, we have done it. We have reached the end. It's been a painful process at times, but we have got there. So can I please remind you of a few things? Please, 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 as admin are about to put up on that chat room maybe, or maybe they've gone home because they're fallen asleep. Please go fill in a class assessment online on the platform at some point. There you go, you see, they're in there. It is very useful for us to assess our KPIs and how well we are providing this service to you. Deep apologies for my voice, which has been a real problem for about a month now. But we've managed to get to the end, not too many breaks at least. Please, if you've not yet booked revision, book revision. With P7, it's essential you do both elements. There are some things where once you know what you have to learn, you can go and memorise it. that this exam is not about memory, it is about practical, and that means guided practice, guided by me. Apart from that, I repeat what I said earlier, various things will appear online as I mentioned at the start of the class in the next day or two. Thank you very much, Claire. I love it when people say lovely things about me. And I would advise you, Claire, to go to the PQ Magazine website where you can now nominate people for awards for the 2015 awards because clearly I am the tutor of the year. Go on, nominate me. It would be nice to have a trophy. Anyway, that's up to you, of course. But thank you very much for being a participative crowd. Thank you, Claire. I will hold you to that. Maybe I'll nominate you as Student of the Year. Independence? Anyway, let's not go there. Thank you very much. Thank you all very much. I hope to see you on revision. I hope to see a mock exam from you as well. Trust me, with this exam, follow my techniques, think about them when doing questions, practice, 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 and on exam day, you'll wonder why the pass rate is so low, because this paper is really not that complicated. Thank you all. It's been a pleasure. Sorry for finishing a bit late, and I will hopefully be seeing you on revision. Enjoy the rest of your day. Bye-bye.